Welcome to the Apprentice Trading Library. This segment will explore understanding the pros and cons of shorting. Short selling is the act of borrowing an asset and then selling it with the expectation of repurchasing it later at a lower price. This can be a powerful but risky tool for investors. Many have a hard time understanding short selling or shorting a stock, crypto, or commodity. The key is keeping it simple. When you buy an asset, you're betting it will go up, expecting to profit when it does. When you short an asset, you're betting it will go down, expecting to profit when it does. Essentially, think about being at a roulette table and either betting on black long or red short. Retail investors generally are only programmed to buy or go long versus shorting assets. This gives institutions exit liquidity when the markets are going to drop. If you ask 10 investors on the street what shorting is, likely only 1 or 2 would be able to explain it and have done it. For seasoned traders and investors, shorting assets is an integral part of how they profit in down markets, just like buying in up markets. Understanding the benefits and drawbacks of shorting is crucial before considering it. Let's explore the pros and cons of shorting an asset. One of the main benefits to shorting would be the profit from market downturns. Short sellers profit when the price of the asset they borrowed falls. This allows them to capitalize on negative market trends or specific company declines. Another benefit to short selling would be hedging other holdings. Investors can use short selling to hedge against potential losses in other parts of their portfolio. For example, shorting a market index can offset declines in individual stocks within that index. The next benefit to short selling is limited losses. Unlike buying an asset, where losses are capped at the initial investment, losses in short selling are theoretically unlimited. However, responsible investors use stop-loss orders to limit potential losses to manageable levels. The final benefit to short selling that we'll explore is market efficiency. Short selling can contribute to market efficiency by identifying and exposing overvalued assets. This can lead to potential price corrections. As for the disadvantages of shorting, first we'll look at the unlimited losses. While mentioned as a pro, this is also a major con. If the price of the shorted asset rises, losses can quickly spiral out of control, exceeding the initial investment. The next con to short selling is margin requirements. Short selling typically requires borrowing the asset and using margin, meaning you only put up a percentage of the total value. While this amplifies potential profits, it also magnifies losses and triggers margin calls if the price moves against you. Another disadvantage we'll look at is short squeezes. If significant buying pressure pushes the price of a heavily shorted asset upwards, short sellers face a short squeeze, forcing them to buy back the borrowed asset at a higher price, incurring significant losses. We also have to examine the ethical considerations. While legal, short selling is sometimes criticized for potentially manipulating markets and profiting from the downfall of companies. Short selling is a complex strategy requiring advanced knowledge and risk management skills. It's not suitable for all investors, especially those with low risk tolerance or limited investment experience. Thorough research and analysis are crucial before attempting to short any asset. Remember, short selling can be a profitable but risky strategy. Weigh the pros and cons carefully, understand the potential risks, and ensure you have the necessary knowledge and risk management skills before considering short selling. Thank you for watching the Apprentice Trading Library. Please visit verifiedinvesting.com for more